Hello and welcome to the Pinnacle Financial Scribble series. I'm your journey's host and financial disruptor, Adrian Harasymiw, wealth builder at Pinnacle Financial. In this scribble session, I will look at one of two common terms used in the world of rough and tough investing, the long position. As always, this is just a quick overview of the concept to help you better grasp an understanding of what it really means. This is not an all-inclusive deep dive and is meant only to give a basic appreciation of the meaning. When you hear someone say they're going long a stock, for example, it means they're buying ownership of that stock. As owners, they will have the right to transfer ownership of the asset, be it through a sale transaction or by way of gifting at their own discretion. And if there's any income paid by the asset, say a dividend-paying stock, or a rent-paying house, as owners, or those long the asset, they have a right to receive that income as paid. In most cases, investors go long on an asset because they also believe it will appreciate or go up in value, and so they are hoping to profit from this increase. So let's look at a hypothetical example. Let's say there's a company called Johnny Appleseed Stands Inc., which has issued ownership shares that trade on an exchange. And now say they're trading at $5 a share, and I've decided to invest $1,000 in the company. This is a buy transaction, allowing me to be long 200 shares in Johnny Appleseed Stands Inc. In other words, I now own 200 shares of the company. And now say in a few months, the stock is now worth $8 per share. I could sell all my shares for a total of $1,600 back in my pocket, which translates to a $600 profit on the investment or 60% return. Of course, if things don't go as I expect with my long position and the stock price of Johnny Appleseed Stands Inc. falls to $3 per share, I will have lost money. I invested $1,000 to receive back only $600, meaning I lost $400 or netted a 40% loss, assuming there are no transaction costs. As a side note, I could say that I am long 200 shares. Alternatively, I could also say I have gone long 200 shares of the company. Both mean the same thing. Based on these two examples, you should quickly notice that the maximum risk of being long a stock is 100% because the stock can fall no further than a price of $0. In other words, I lose 100% of my investment, but no more. Alternatively, there is no theoretical cap on the amount of money I could make going long on an asset, as the price could mathematically rocket to infinity. But that ends our quick discovery of the term long position in investing. Be sure to subscribe to this Pinnacle Life channel to find your way back to my scribble session on long's opposite, the short position. It's not as well known, though much more daring in scope, so you won't want to miss out. Remember, I've got the perfect place for you to collect all your thoughts and information. Simply go to www.mypinnaclelife.com, where you can join my free weekly Pinnacle Chronicles email, and then I will send over to you one of these spiffy My Pinnacle Life notebooks. And now, let's get your skin in the wealth game and on your way to the pinnacle.